Welcome everyone to our webinar on Demystifying ESG, why placing ESG at the heart of your business can help you thrive in a post-COVID world. My name is Katharine Lewis. I'm a partner in the banking and finance team at Trowers Hamlins with over 15 years experience of advising both borrowers and lenders in all aspects of property finance. Over the past couple of years, my practice has become more heavily involved with environmental, social and governance issues. And we thought it would be really helpful to run this webinar to ensure that people understand what we mean when we're talking about environmental, social and governance. With me today are Dana Hanby, who is a director of ESG Nexus and has close to 20 years experience in sustainability, energy and environmental markets. She works with the financial and other sectors on the integration of ESG into financial portfolios and core businesses, and has been working with leaders across the value creation chain to devise and implement strategic sustainability agendas. She has increased liquidity of environmental products and services in her role as global lead of sales for the second largest derivatives exchange in the world. She has also worked closely with the World Bank on increasing efficiency in the climate market in her role as chair of the Reserve and Rating Group with CMIA. Dana is going to be talking to us about what exactly we mean when we talk about ESG in a financial context. I'm also joined by Rebecca McKay, who is a partner in the pensions team at Trowers. Rebecca has over 15 years experience in the pensions sector and advises on all aspects of pensions law, including general advisory, corporate acquisitions, risk management exercise, including scheme closures and buyouts, restructurings, governance issues, and dispute resolution. As part of her role on the Association of Pension Lawyers Subcommittee on Investment, Rebecca has been closely involved in the development of recent legislative and regulatory changes in the UK, which have resulted in ESG factors being put at the heart of considerations for pension trustees and asset managers. Rebecca is going to look at some of those recent changes which have resulted in ESG becoming such a key factor for pension trustees and asset managers when making investment decisions. And finally, we're joined by Naomi Europa. Naomi is, like me, a partner in the banking and finance team at Trowers and has over 14 years experience in the affordable housing sector. She is a highly respected advisor in her field, and her practice covers both acting for borrower and lender clients. Most recently, Naomi has been working with the Good Economy on the development of a sector standard approach for ESG reporting in social housing. Naomi is going to briefly look at the ways in which businesses can access ESG finance, the importance of being able to capture the metrics correctly, and the value of data. And I will briefly outline the reasons why we think putting ESG at the core of your business's strategy may benefit it. Without further ado, let me hand over to Dana.
Thank you, Katharine, for this introduction and for your invitation, and welcome, ladies and gentlemen. It is a great pleasure indeed to join this discussion today and to see growing interest in ESG. And ESG can sometimes be confusing. We hear many words or acronyms that appear to describe similar efforts. So sustainability or green is not exactly the same. And often these efforts are treated as an add-on to the business. So even though a company may have a sustainability department, the board of this company may not always see the relevance of environmental, social, and governance factors to the business and financial performance. And I was actually asked very directly by a CFO of a large manufacturing company with international presence that I was provided consultancy to, how relevant is ESG to him, apart maybe from seeing increasing amount of posters with the environmental content on his way to kitchen. And this was a few years ago, so this situation is changing, but we still have some confusion on the board and some way to go if we want to achieve the objective of sustainable development goals or Paris agreements and so on. But it is a very broad topic, but as the title of today's conversation is Demystifying ESG, let's go directly to ESG. And if we look at the definition of ESG, even if we use Wikipedia, it describes ESG as referring to the impact of 3 central factors, so environmental, social, and governance, on investment. in a company or business. So it immediately focuses our attention on investment. And indeed, the key objective of ESG integration is to improve the risk-return characteristic of a portfolio. And as I used the phrase impact of environmental, social, and governance issues on investment, perhaps I should also add some further comment, because I often hear that ESG is equaled with impact investing. And I mentioned the key objective of ESG integration is to improve the risk-return characteristics, whereas a key objective of impact investment is to trigger change specifically in social and environmental area. And there's always a nuance, so also this time, of course, ESG integration can include impact investment, and indeed, investors are increasingly encouraged to invest in companies that have the potential to be transformative and generate returns that make society and markets better. But so ESG integration, how does it improve risk-return characteristic of a portfolio or a business? And even if we look at the question itself, it suggests that we're looking at value of the company, not only values. And if we are talking about the value of a company, what is important is its business model, how competitive the company is now and in the future, what risks the company is facing, and how these risks might evolve in the future. Also, the context that the company operates in is important. So what is the industry that we are looking at? What are the regulatory changes that this industry might face? So everything that you look at to assess the value of a company is relevant, but you are doing this through the lens of ESG factors, and you start from determining what ESG factors are material for your business. And there are various ways to do it. There are also organizations that are helping specifically in determining materiality of ESG factors for any specific industry. This is, for example, SASB, so Sustainability Accounting Standard Boards, but there are also other standards, and they're all working together to make sure that the standards are aligned, that we can't expect perfect alignment because each of these organizations, of course, have different purpose. And let me also include an example to very briefly illustrate what I mean and how does it look in practice. So I will start from a very straightforward example, but as I know also that the audience will be interested in real estate, I will also include a real estate example. So let's at the beginning start just a very brief look at coal power plant, because even intuitively we know that power plant and carbon emissions will be impacting the activities of a power plant. We know that coal power plants are polluting. We can measure it. A ton of CO2 is a commodity traded on exchange or bilaterally, so we can put the price on the pollution. So it should be also obvious for the board of this company what impact the pollution has on their profit and loss. And there is also a competitiveness issue. We know that some exchanges have already delisted coal, so stop trading coal. Banks declare that they will not be financing coal projects. There is an issue of stranded assets. We are talking about carbon bubble, so incompatibility between continued development of fossil fuel projects and combating climate change. So just like you would not invest in a business that produces VHS tapes in an era of streaming, and I'm giving this example only because we have a longer time perspective and we can see what directions the technology moved. You can also see the direction of movement for ESG integration. So if you don't do anything now, your business may be at a competitive disadvantage later, and this is at best, or at worst, its viability may be put to question. And as I know that we have some finance directors in the audience, let's take a very brief look at the value through the discounted cash flow. And I mentioned competitiveness and long-term viability of the business. So they are elements that will impact future revenues of this company. And companies that have better ESG, the performance of these companies tend to be more efficient, they more efficiently use their resources, hence they will have lower costs. They also are often more innovative and they have better long-term profitability, and they are perceived as less risky. And risk is yet another key element in calculating discounted cash flow. So high ESG ranked companies tend to have lower incident risks, they tend to better manage risks within their supply chain, they have better risk control standards, and I'm sure that we could hear many examples on how litigation risks can impact companies' financial performance or even business viability. So in this example of our coal company, we have many ESG elements that the board should be interested in. But it's not only the board who should be interested in, because investors are definitely interested in. And indeed, investors themselves face a great pressure to decarbonize their portfolio. They are asked to report alongside TCFD guidance, so looking specifically at governance, strategy, risk management, and metrics, so areas that we've already discussed earlier. And of course, investors are looking at the ESG reporting provided by any given company, but they're more sophisticated than that and want to know not only what is the company's impact on the environment, so the carbon emissions in the case of our power plant, but also how the environment and broader ESG factors impact the company. So the entire avalanche of new regulations, impact of supply chain, and so on. And I will come back to investors slightly later, but as I mentioned, that ESG issues that are material depend on the industry that the company is in. And as I understand, many people in our audience are interested in real estate. I want to add an example related specifically to real estate, as it shows some interesting dynamics. So starting from the impact of the real estate on environment, it's almost intuitive if we look even at our private experience, that when we increase energy efficiency of our homes, our energy bills will reduce. And indeed, it is estimated that buildings account for close to 40% of energy-related carbon emissions. There is a nuance, as this includes operational carbon, so the energy efficiency of the building, and it's so-called embodied carbon, so related to the construction materials. So if you use more insulation to make your home more energy efficient, yes, you basically lower the operational carbon, but you increase the embodied carbon. So within the real estate, it's extremely important to actually look at and work collaboratively with entire value creation chain to optimize a solution for reduction of carbon emissions. But so this is the part where real estate affects the environment. But what is increasingly interesting is how the changes in climate will impact any given real estate. And there is a very good study done by McKinsey, which has carried a simulation for 2 cities with contrasting characteristics. So the cities that were considered were a coastal city, Ho Chi Minh in Vietnam, so an emerging economy where flooding is already part of their life. And another city is in a mature economy, Bristol, so in the UK, which for the first time in generations is developing a significant flood risk. And McKinsey research carried out simulations and looked at 3 scenarios. Each of these scenarios explore impact of increased severity of flooding due to increased precipitation and seawater rises with progressing climate change. And the first scenario was done for today. And severe flood in Ho Chi Minh today could cause hundreds of millions of dollars in infrastructure damage and about $1.5 billion in real estate damage. But the magnitude of damages, understandably, in the 2 remaining more severe scenarios are many times higher. And the consequence of a major flood in Bristol today would be relatively small, but not immaterial. But if we look at the more severe scenarios where water exceeds the city's flood defenses, the potential losses are devastated and calculated in the millions of dollars of infrastructure and property damage, and the resulting knock-on effects could last for months and results in even higher losses. And the assumptions for these 2 more severe scenarios were that the cities stay still as they are today. And of course, this is not the case because cities undertake various adaptation action. However, because the Vietnamese city is still reasonably early in its development journey, the city still has many options to avert the devastating impact of the events in the 2 severe scenarios. Bristol is building flood defenses wall. It's cost city something like 130 million. However, it has fewer adaptation options than the Vietnamese cities, as the most of the infrastructure the city plans to have in place in 30 years' time has already been built. So if you're an investor and want to include real estate to your portfolio or indeed finance it, then you definitely want to know what may happen to your money because of the ESG issues, and climate is one of the key factors that are looked at. And you want to know how do you price the risk and how you can hedge the risk. And as the demand for such information increases, there are companies that are focusing specifically on detailed spatial modeling of impact of flooding on a real estate and an individual asset, also impact of fires. And actually, one of such companies has recently been taken over by one of the big 4 rating agency. And we have also progress in the development of spatial finance. So if you don't want to properly disclose ESG or work on improving your ESG credentials, it is working as a disadvantage for you, not only because lack of transparency is usually taken quite badly and it is a red flag for investors, but also if you are a large company, you're obliged to make disclosures. We have a non-financial reporting directive, so it makes sense to do it right. And because it also is helping you not only to determine ESG factors that are material to your company, but it helps in addressing them and also show the potential impact of ESG factors on the value of your company. And it is worth remembering that investors are getting increasingly sophisticated with information gathering. They use more than one data providers and data analytics for assessment of any company. We also have natural language processing. So it is possible to see the news feeds related to any company in real time, and not only categorize quickly the type of news about the company, but also monitor the changes in the number of news about any company, which is also taken as an indicator of the company performance or the change in this performance. And as the sophistication grows, so do the requirements. And what is increasingly important is not a static once a year reporting on the status quo of ESG performance, which is almost obsolete at the time of issuing it, but investors are looking at a more dynamic assessment. So looking at the momentum of changes in the ESG performance, so how you're improving or not your ESG credentials. So no matter at what stage of ESG integration you are at, there is still a great amount of work to do and to ensure that you positively progressing on your ESG performance. And I mentioned particular two examples and highlighted predominantly environmental aspects. So E is in ESG, but the social aspect started to grow in importance already earlier. And indeed, the unfortunate situation that we have with COVID only accelerated it and brought the social aspect to greater focus. So we know the direction of moving, and there will be winners and losers because of the ESG. I hope that everybody in our audience want to join the winners. So I hope that we will have time at the end of this podcast for questions. I'm very happy to answer any questions. And of course, you're also welcome to contact me via LinkedIn or the contact page of ESG Nexus if there will still be something remaining. So thank you.
Thank you, Dana. That was really interesting. Rebecca.
Yes, thank you very much, Dana. I definitely agree. That was really interesting to get such a clear insight into the value that organizations will get from putting ESG at its heart. What I would like to focus on over the next 5 minutes or so is the critical role that pension schemes play and will continue to play in the development and growing importance of ESG and sustainability, if you like, for corporates and all other different types of organizations. And I think just to put that in context, the importance of pension schemes in the investment chain and the entire investment ecosystem is underlined by the fact that there's an estimated £2.2 trillion worth of assets under management held by UK pension schemes. So what they think in terms of ESG and sustainability and the value they place on risks associated with those factors has a profound effect on really the whole economy and on how organizations need to structure themselves and what emphasis they need to place on ESG. So what do pension schemes, what is their view on sustainability and ESG? Well, if you look at pension scheme liabilities, they are long-term in nature, often stretching 20 or 30 or 50 years in the future when members come to retire and take their pension. And so the nature of ESG risk, ESG factors and the risks associated with them are something that pension schemes should always have taken into account and paid really close attention to in terms of the financial impact. But that has not always been the case. And many pension schemes have perceived ESG in the past as something that's more of an ethical or moral issue or quality of life issue, rather than something they need to focus on in terms of financial returns and risk-adjusted returns. But what I would like to get the message across today is that there has been a huge sea change in the way pension schemes are perceiving those risks, which really got going in earnest last year in 2019, but will continue to evolve over the next few years. There's been a couple of reasons for this. The main one is a huge raft of new regulatory changes that the government's put in place, really to make pension schemes sit up and take more notice of ESG. I'm not going to go through them all now because we don't have time, but essentially pension schemes need to put together a policy on how they're going to take into account ESG financially material factors when investing. Later this year and coming into next year, they're going to have to publish on a publicly available website an implementation statement as to how they have put into practice that ESG policy, i.e. what changes have you made in your investments to comply and make sure you're taking account of those risks. And looking even further ahead to the future, there's going to be a lot of new disclosure requirements put on pension schemes where they will need to probably disclose in line with TCFD recommendations. So this has driven the huge change. Another key reason is member engagement. Over the last few years, members of pension schemes have become hugely interested in where their funds are invested, and in particular, the ESG risks associated with those investments, and whether or not it goes a step further and whether those investments are actually having a positive impact on people and planet. So that has also driven a huge change in how pension schemes are structured and the way in which their funds, those £2.2 trillion worth, will be invested going forward. So what does that all mean if we are looking at individual organisations at the moment? Well, I think it comes back to what Dana was saying. There is a huge opportunity here for organisations to get competitive and also to remain viable by looking at their ESG footprint now and assessing where it is and being able to disclose in meaningful metrics what those are in order to benefit from this huge change that's happening in the overall investment chain and ecosystem, which has been driven by pension schemes, which means that lots and lots of those funds will be in the future invested in organisations that have actively looked at their ESG footprint. But I'm very happy to take questions, but that was really all I wanted to mention just now.
Thank you, Rebecca. Again, that was super interesting. Naomi, perhaps you can give us a bit of a view on what's going on from a lender perspective.
Thanks, Katharine. So I'm going to be talking to you a little bit about sustainable finance and the different kinds of financing that are available. Now, sustainability really has become an absolutely key priority to investors pretty much over the course of the past 18 months. They've all woken up, they've all realized that this is something that they need to be paying attention to, and that more importantly, that for their borrowers, that this is something that if you are looking to borrow sustainable finance, you need to be very aware of. So investors have realized that finance really does have a crucial role to play in tackling climate change. Investors are beginning to evaluate their portfolio performance, not just on their financial performance, but also with an eye to ESG issues. And this goes far beyond negative screening. And negative screening is where investors might decline to invest in areas which are viewed as problematic, such as coal or tobacco. This is a move towards true integration of ESG factors into the investment process. And it's a simple risk management issue for investors. There is a pure reputational risk in not being seen to be on top of this issue. Fund managers need to be able to account to their investors on the ESG performance of their portfolio. But most importantly, banks need to be able to report their ESG credentials to their investors. And what this means for you is that from a risk management point of view, banks need to ensure that those that they are lending to are integrating ESG metrics into their businesses. Now, there are a variety of green finance products available, and there's a huge pent-up investor need for these green products, which is really understandable when you consider that green growth in the UK is 4 times faster than the rest of the economy. So there was a 2020 survey of fund managers, and it was carried out by a US private bank called Brown Brothers Harriman. And it said that 74% of global fund managers plan to increase their ESG allocation over the course of the next year. And that's a phenomenal amount. I mean, it's an absolute sea change. We really can't understate, how significant the move towards ESG has been over the course of the past sort of 18 months, really. Now, you can access sustainable finance via a variety of methods. The first one we're going to talk about briefly is green loans. Green loans have to be in accordance with LMA green loan principles, and a green loan has to be used to finance or to refinance any eligible green project. And the proceeds, they must be used for a green project. And a green project has to have a clear environmental benefit, such as tackling climate change, loss of biodiversity, etc. Now, if you're borrowing a green loan, you have to keep the proceeds of it in a locked, dedicated account, which might, that might be favorable or not, depending on your needs. And the borrower has to report on the green project and be able to account to the lender for how it is chosen how it is made its choice of green project. What eligible factors did it take into account? The borrower also has to agree a series of performance indicators, and these require third-party verification. Now, lately, we have found that sustainability-linked loans are a very popular green finance product. And the reason why they're so popular is that the proceeds of a sustainability-linked loan can be used for anything. You can use them for any purpose you fancy. However, the margin under a sustainability-linked loan will be linked to certain ESG-related metrics, which the borrower sets. So a borrower can set targets in relation to, say, getting people into work. You might want to decide that you're going to set metrics that over the course of the next 6 months, you're going to get a certain percentage of people back into work. It might be about improving fuel efficiency or improving the energy efficiency of buildings. And the borrower self-certifies its own performance against those metrics, which is another reason why sustainability-linked loans are so popular, is there's no requirement for third-party verification. So if the metrics that the borrower has set are met under the loan, the margin reduces. But if they're not met, then the margin increases. Now, you can also access green finance via the capital markets, and green bonds and social bonds are becoming increasingly popular. Now, in 2019, there were 479 green bonds issued worldwide. And green bonds, like green loans, the funds have to be used for a climate-related or environmental purpose. But this year, we're seeing a massive increase in social bonds. The pandemic has really focused people's attentions on their local communities. And for social bonds, the proceeds have to be used for a positive social outcome. And the definition of that is pretty wide-ranging, and it includes such things as affordable housing, which is why it's so popular with RPs, employment generation, food security, socio-economic advancement, etc. Now, your green bonds and your social bonds, they both have to be issued in accordance with the International Capital Markets Association guidelines, and you need third-party verification. That's quite important. So you'll have to look at a green rating agency, of which there are a variety that have popped up, of which the most popular are Sustainalytics and Viago Eris. And finally, a very quick note on data. Now, data could have an entire webinar all on its own. It is becoming absolutely vital to ESG that you have good data. Investors need solid, comparable, verifiable ESG data. Now, in order to access all the various methods of sustainable finance that I've mentioned, you need to know what ESG data you hold, and more importantly, what you should be holding. Now, the chances are that if you're a business listening to this, you probably are doing everything you already need to. You're just maybe not badging it as ESG. but you need to start looking into what data you hold in terms of your supply chain, in terms of energy efficiency, and you need to work out what you should be holding so that you can articulate your ESG credentials a little bit better to any potential investors. So that's all I wanted to say. So I'm going to pop you over to Katharine.
Thank you, Naomi. I will try and summarise all of that in just a moment. But before I do that, I see we've had a number of questions coming in on the Q&A, a couple of which look like, Dana, they will perhaps be things you might be happy to answer. So if I could get you to think about those whilst I am talking for a few minutes, that would be great. Thank you. So I was just going to say, for many businesses, practicing sustainability in an authentic and meaningful way may mean the difference between surviving and thriving. In the current environment, it's no longer enough to view integrating environmental, social and governance into your business as being nice, as not only does taking a closer look at your ESG strategy make good financial sense, it's also an opportunity for brand enhancement and to attract talent and customers. Consumption has become more value reflecting than ever before, and this extends beyond our personal interactions as consumers, as companies are increasingly looking up and down their supply chains to make sure that the people and the businesses that they partner with are engaging in ESG practices which support their views and values and make a positive contribution to the society in which they operate. As you've heard, one of the main things for businesses to consider when thinking about ESG is to attract investment. ESG investing has grown rapidly in recent years. A combination of generational wealth transfer to ESG savvy investors and increasing regulation and regulatory pressure means that for businesses that are looking to attract and retain investment, putting ESG at the heart of its strategy is becoming ever more important. Over the past 2 to 3 years, as I've said, we've seen huge growth in the number of sustainability focused funds. And according to some recent data from Morningstar, annual European sustainable finance flows increased from 50 billion euros in 2018 to a record-breaking 120 billion euros in 2019, bringing the total assets under management in the sector to in excess of 660 billion euros. That money's got to be invested. And so whilst ESG funds may take different approaches to selecting the businesses that they are going to be investing into, that money has got to be spent. And so for businesses that are looking to attract investment, reviewing their strategy to identify the material financial risks to that business which are arising from, for example, climate change, labour practices, data privacy, or business ethics and behaviour, and making genuine and meaningful changes to combat the risks that are identified as part of that process is likely to be a worthwhile exercise in terms of making them more attractive to investors. Similarly, regulated financial institutions like pension fund trustees and asset managers are increasingly taking businesses' ESG policies into account when they're undertaking their risk analysis as part of making credit decisions. You've heard quite a bit on that from Naomi, so I won't labour the point, but like investors, lenders perceive businesses that have adopted good ESG policies as being more robust and better able to anticipate and react to global events. And many now offer much more favourable credit terms to businesses that are taking account of financial risks that are posed to their business by the relevant impacts of climate change and poor corporate behaviours. This can take the form of better terms because the business is assessed overall as having a lower risk with it, or because the monies that are being borrowed, as you've heard from Naomi, to finance specific projects or to help meet particular targets. And those targets are usually specifically to improve either a business's environmental impact, its social impact, or perhaps both. Green, social, sustainability-linked and transition loans, which include incentives such as lower margins, are all now a familiar part of the lending lexicon. And even though interest rates in the UK are at historic lows, as a business, being able to access credit on more favourable rates by demonstrating that you are managing risks and looking to the future should not be overlooked. We've seen a number of high-profile examples of companies that have failed or suffered significant impacts as a result of engaging in poor corporate behaviour. Most recently, Boohoo lost 46% of the value of its shares in the first 7 days after allegations of malpractice in their factories in Leicester surfaced. On the whole, businesses with an ESG focus, though, have outperformed their counterparts during the first half of 2020. And whilst not all businesses may have the R&D budget of, for example, Nike, whose Flyknit range of products produce 60% less waste than traditional cut and sew methods and use 100% recycled core polyester yarn, and have resulted in in excess of a $2 billion revenue from the range. A recent article by Nordea Bank pointed out that small businesses which operate on smaller margins may be able to save an awful lot, both financially and in terms of their carbon footprint, through making relatively small micro changes, such as switching to digital receipts, using non-disposable coffee cups, switching to renewable energy, and improving their waste management. Finally, one of the other reasons for all businesses to think about ESG is in terms of attracting and retaining talent. The sustainability credentials of a business are increasingly important to people entering the workforce around the world, and studies have shown that initiatives aimed at improving ESG performance and proving your value to society as a business can increase employee loyalty, efficiency and productivity, and also improve HR statistics related to recruitment, retention and morale. Firms with greater corporate responsibility performance can significantly reduce staff turnover, resulting in savings for each of those businesses. And companies that invest in sustainability initiatives tend to create a sought-after culture and engagement due to strategy focusing more on purpose and providing value to society. In addition to this, companies who embed sustainability in their core business strategy treat employees as critical stakeholders that are just as important to them as their shareholders. Employees are proud to work there and to feel part of that broader effort. And in the modern digital age, that is increasingly important because people want to be proud of the names of the companies that they work for and that they're putting on their CVs, both on things like LinkedIn and in more traditional forms of recruitment. So in short, putting ESG at the core of your business's strategy, in our view, is likely to have a benefit. Whether that is a benefit because you are better positioned to attract investment, better able to access credit on more favourable terms, and more likely to attract and retain talent. The world is your oyster. So, we've had some more questions whilst I've been chatting, and we also had some questions that came in before when people registered. So I'm just going to pick up one of those first. Naomi, one of the questions that came in from before the webinar started was around the RP sector and what progress the sector has made on consistent measures, and what sort of specific things are investors looking for from the sector?
Sure. So I think that the RP finance sector is sort of at its early stage of its ESG journey, I think it's perhaps fair to say. At the moment, there is a move that towards standardizing reporting standards. So the Good Economy, which is an ESG consultancy firm, has come up with a project spearheaded by Peabody and Centris, and we are sponsors of it at Trowers Hamlins. And there have been a number of RPs in the sector involved, such as Clarion and Optivo, along with they now have a number of investors on board, M&G, THFC, NatWest are heavily involved. And the idea is to come up with a set of criteria that any RP, no matter how big or how small, can report on an annual basis. And I saw that somebody had asked, I mean, I'm sure Dana can pick this up as well, about whether there is a sort of a weighting between the E, the S and the G. And the idea is that everybody should be able to report on a variety of criteria covering all three of those areas. There's no weighting between them on an annual basis. And so a white paper has been produced, and we are still in the consultation phase of that until the end of July. And then after that, they are going to look to have people who might wish to be early adopters of this, who are going to agree to report on it on an annual basis. But the idea is to basically help everybody to be able to get a set of standardized criteria that everyone can report on. Because as I said, the banks need comparable data. They need to be able to know. And it's not about winners or losers in terms of, we don't want to have a tiered system, but the bank needs to be able to look and be able to report to its investors on, you know, the ESG performance of its borrowers, and to be able to sort of say, yes, this is a metric, these people have met this, these guys have not, but they might be doing brilliantly in other areas. And it's all about step one of a journey. I mean, we will inevitably move, I think, in the sector towards impact investment, which is about trying to determine what good means in terms of the social, in terms of the good that you do in your local community, in terms of how do you value your green space, how do you value the biodiversity, how do you value your projects about teaching people about fuel, about literacy, about getting people into work. We will move towards that, but that is so much harder in terms of quantifying and reporting on. So I think right now, in the social housing finance sector, it is about getting a standard set of criteria in relation to environmental, social, and governance that anyone, even the smallest guys, can report on an annual basis to basically help the investors out and to make sure that the RPs aren't drowning in a variety of different ESG questionnaires from different people. We want to make life simple for everybody, basically.
Thank you. As Naomi mentioned, one of the questions that we've had from the audience is, currently, do each of the E, S and G have different rankings, or are all equally important? And I'd be interested on views from the rest of the panel on this, because I would have said that the answer to that is both yes and no. As a business, you have to look at and assess what the material financial risks are to you coming out of each of environmental, social and governance. And you have to address those risks in the way that is going to be best for your business, and to ensure that you're combating those things. But at the same time, you have to ensure, and actually the European Green Bond sort of strategy sort of goes towards this, you have to ensure that you are not having a negative impact on any of the other criteria whilst trying to take positive steps to improve your performance in a particular area. But I don't know whether Rebecca or Dana, either of you have a view on that.
Yeah, it is. You're right, Katharine. It's a really interesting point. And I think what I would say from an investment, looking at it from not the banking perspective, but the pension scheme investment side of things, pension schemes are now looking at E, S and G from a risk-adjusted returns perspective. So if they feel there's potentially a lot of E risk in their portfolio, and say an organization has got a very good E profile but a bad S and G profile, then the fact that they've got a good E profile might be something that makes it okay for them, because that's what they're looking to hedge against, if you like. But it will all be looked at in the round, and clearly you want to have as good, up all of them, but that's clearly not going to be possible in all cases. But I think investors do acknowledge that and understand that, and will invest accordingly, bearing in mind their own specific risks in their portfolio.
I would, if I can add to this, basically I would steal your phrase, yes and no, Katharine, because it depends what you are looking at, and what Rebecca already said. It depends from the ESG perspective what is material. And as we have a question about Tesla, actually, Tesla is a very interesting example, because if you look at some rankings, Tesla scores very highly, and in others not so high. And why is that? And it depends what it is that we are looking to answer. So if we are looking at green revenues and green revenues only, then indeed Tesla may score very highly. But with the overall ESG perspective, so reducing risk return characteristics, the supply chain plays a great role, the S part plays a great role. So what risks are there, and what is material? That is sort of a recurring theme throughout this conversation. So I agree with with what has already said.
If I can just add just for a second, because Katharine mentioned transition loans, we also have to recognize that there are a lot of companies that might be in coal or in power and things that aren't particularly green. And the idea is to transition them to a shinier, greenier, sustainable future. So from that perspective, I think investors, if they recognize, for example, that they might score very highly on the S and the G, but very poorly on the E, then there is still a recognition that they are on that journey and they're still to be encouraged, even though their metrics across all three are not going to be, they're not going to be weighted equally. So I think obviously, ideally you want to have good on all three aspects, but I think that there is a recognition that for some companies that are looking to transition, that they are not going to be able to score very highly on certain elements, but that they should still be moved towards a better way, which is part of what transition loans are all about.
If I
Yes,
can add to that, because it's a great point. And yes, indeed, the transition is something that the investors want to see, that companies are improving. Maybe I wanted to add something that it's not necessarily that optimistic, but they are also investors that are very much looking who will be the losers in the transition, who will not actually follow the direction of moving that I've mentioned at the beginning. And there are already some funds that are ESG long-short funds where the funds managers are looking at shorting companies that may consistently not perform on ESG.
Thank you. Now, one of the other questions that we've had in, and Naomi, I'm hoping that you will be able to perhaps you'll have a view on this, is if a company issues a green bond in the UK, do the funds have to be spent in the UK? Is there a minimum size required to make a green bond attractive to investors? And also, is there a sort of a minimum size to make it cost efficient? Now, in terms of the first part of that, as far as I'm aware, the proceeds don't have to be spent in the UK. They just need to be spent on the specific projects that have been identified. But I mean, do you have a view on sort of minimum size in terms of attractiveness and efficiency?
I mean, I think in terms of the capital markets, if you are going to go out with a bond, either a green bond or a bond with any form of ESG wrapper, you're going to be looking at an absolute minimum of 50 million, probably more like 100 million, in order to be able to attract the best kind of investors and to get the best kind of pricing spread. In the moment, there's very low gilt yields in the capital market, so they're very attractive at the moment. But I think in order to attract the best amount of competitiveness and pricing crunch, you would want to have a fairly decent sized facility to go out there with. I mean, as I said, there were 479 last year green bonds, but actually, if you think about in terms of the capital markets, that's not necessarily a huge amount, but they are increasing. Social bonds, as I said, are very popular right now. But I think you would need to have a decent financing need of kind of 50 million minimum, I think. And also in order to, as the gentleman, I'm assuming there, sorry, Robin pointed out, it needs to be cost efficient because the costs of doing a bond issue are not necessarily particularly cheap.
I think also I would add to that, it's worth looking at the different places in which you could list the bonds, because I know there are a number of stock exchanges now that have specific sections within their listing categories for green, social and sustainability linked bonds, and certainly a London Stock Exchange listing, not terribly cost effective, I don't think, and so as you say, it needs to be of a certain size. But you might consider listing in perhaps Jersey or Guernsey as an alternative if you've got something that's a little bit smaller, but you still want the benefit of having kind of green or sustainability linked bonds. I'm conscious that we are very nearly out of time, but I just wondered, Dana, whether you could quickly answer the question that had come in from David as to practical tips on that businesses can take in order to get going in developing their ESG footprint.
In 1 minute, because we are talking as ESG, so the risk return characteristics, the best is to start with building a materiality map what is material for this business and see what the business is already doing, where the business is at, where it's going to get. So build kind of a scenario how to get it, starting from determining where it is now and what is material for the business.
Thank you. As I say, I'm conscious that we are almost out of time. David, you had a couple of other questions, which we will come back to you separately on. If anybody in the audience does have questions for any of us, please don't hesitate to get in contact. I think our contact details will be circulated along with the recording of the video. And thank you all for your time joining us today to listen in. And thank you, Dana, Rebecca and Naomi, for a very interesting and informative discussion.
Thank you.
Thank you.